A tsunami is coming to the crypto market. A game-changing investment opportunity is emerging. Do you want to be one of the first to seize it? Join us as we explore it in today's video. Stay ahead of the crypto curve and discover new MMO opportunities. Subscribe to MMO Crypto today. Forget the noise and the daily price swings. While retail investors are often caught up in the short-term drama, something much bigger is brewing behind the scenes. The real movers and shakers of the financial world, institutional investors, are quietly positioning themselves in the crypto space, and two assets in particular are catching their eye: HBAR and XRP.0. So what's the big deal? Well, many analysts are predicting a massive influx of institutional capital into crypto, especially around 2025. They're talking about an institutional floodgate opening. This isn't just wishful thinking. It's based on growing regulatory clarity, advancements in blockchain technology, and a general acceptance of digital assets as a legitimate asset class. And when that floodgate opens, HBAR and XRP are expected to be right in the path of the incoming tide. This anticipation alone is a major reason why smart money is already starting to accumulate these assets. Let's focus on HBAR for a moment. What makes it so attractive to these big players? It's not just hype. We're seeing real evidence of institutional interest. Think about pension funds, wealth managers. These are the heavy hitters of the financial world, and they're starting to explore HBAR. It's not just exploration either. Some are actively investing. This isn't just a few small firms either. We're talking about significant numbers of large institutional clients. So, why HBAR specifically? Several factors are at play. The Hedera Governing Council, with its roster of established global corporations, lends a huge amount of credibility and stability. This is crucial for institutions who value trust and long-term viability. Furthermore, HBAR's focus on enterprise-grade solutions and its unique technology gives it a strong use case in various industries. This real-world utility is a key factor for institutional investors looking beyond speculative trading. While the discussion has focused on HBAR, it's crucial not to overlook XRP. Although the video doesn't delve as deeply into specific institutional clients for XRP in this section, the overarching theme of institutional interest in the crypto space, especially in anticipation of 2025, directly applies. The mention of Wall Street coming for your XRP in the video title and the broader context of impending regulatory clarity for the crypto space implies that institutions are indeed keeping a close watch on XRP's developments as well, especially considering its focus on cross-border payments and established partnerships within the financial industry.
Institutional clients, these are private fund managers, pension fund managers, wealth managers of all sorts, and they take their first steps into crypto via Uphold International's platform called Ascent. And as soon as we opened Ascent and talked about what tokens we would make available to big institutional clients, we asked them, what would you like? And the immediate answer from them was HBAR. So there's definitely awareness and there is demand, right? Not everyone is a maxi of something, and Uphold certainly isn't. If we are a maximalist in anything, then it is the interoperability maximalism. We believe that there should be 1,000 different chains, but they should all be able to talk together. And the messaging system, the scalability, the ease of use, and of course the governing council of Hedera. I was pretty awestruck when I saw that the first time, who is on the governing council of Hedera.
In the wild world of crypto, where projects can spring up overnight and disappear just as quickly, trust is everything. For big institutional investors who are managing billions of dollars, that trust is even more crucial. And that's where the Hedera Governing Council comes in. It's not just a list of names, it's a powerful signal that attracts serious investment. Think about it. When you're investing other people's money, you want to know it's in safe hands. The Hedera Governing Council isn't made up of fly-by-night startups. It's filled with some of the biggest, most established companies in the world. We're talking about household names, blue-chip corporations that have been around for decades, even centuries. These aren't just random endorsements. These are active participants in the network's governance. This presence of these established players does wonders for Hedera's credibility. It instantly builds a level of trust that most crypto projects simply can't replicate. For institutional investors, seeing these familiar names gives them a sense of security and stability. They know that Hedera isn't just a fleeting trend, it's a project with serious backing and a long-term vision. This is essential for institutions who are looking for sustainable investments, not just short-term gains. It's important to understand that these members aren't just there for show. They actively participate in the governance of the Hedera network. They have a say in key decisions about the platform's development and direction. This active involvement provides a level of oversight and accountability that is highly appealing to institutional investors. It shows that Hedera is committed to responsible growth and long-term sustainability. In a crowded crypto landscape, the Hedera Governing Council is a significant differentiator. It sets Hedera apart from many other projects that lack this level of institutional backing and governance. This unique structure gives Hedera a distinct advantage when it comes to attracting big money from institutional investors. It's a key reason why Hedera is seen as a more mature and reliable investment opportunity compared to many of its competitors. The crypto market is famous for its wild price swings. One minute everything's up, the next it's crashing. During these turbulent times, you often see a stark difference in how retail investors and big institutions behave. It's a classic case of fear versus strategy, and it can tell us a lot about smart investing. For many retail investors, these market drops can be incredibly stressful. They see their portfolio value plummeting, and it's easy to get caught up in the fear and panic. They start thinking, I need to sell before I lose everything. This emotional reaction often leads to selling at the worst possible time, right at the bottom of the market. This impatience and fear-driven decision-making is a common trait among retail investors, especially those new to the crypto space. Now let's look at what the big institutions are doing during these same market dips. Often, they're doing the exact opposite of retail investors. They're buying. They see these price drops as a buying opportunity, a chance to accumulate assets at a discount. They have a longer-term perspective and understand that market volatility is a natural part of the investment cycle. They're not driven by emotion, they're driven by strategy. There are a few key reasons for this difference in behavior. Institutions typically have much longer time horizons than retail investors. They're not worried about short-term fluctuations, they're focused on long-term growth. They also have access to more sophisticated research and analysis tools, giving them a better understanding of market trends. Plus, they often have larger amounts of capital to deploy, allowing them to take advantage of these dips. The key takeaway here is that we can learn a lot from how institutions behave during market volatility. While it's natural to feel some anxiety during price drops, it's important to avoid making emotional decisions. Instead, try to adopt a longer-term perspective and view these dips as potential buying opportunities. This buy low, sell high strategy is a cornerstone of successful investing, and it's something that institutions have mastered. By understanding this contrast, we can become more disciplined and successful investors ourselves. The world of cryptocurrencies is constantly evolving, and now a major player from traditional finance is signaling a potential shift in strategy that could have huge implications for the altcoin market. We're talking about Franklin Templeton, a Wall Street giant with trillions of dollars under management. Their potential interest in altcoins is a significant development. For a long time, institutional interest in crypto was primarily focused on Bitcoin and, to a lesser extent, Ethereum. These were seen as the blue-chip cryptocurrencies, the safest bets. But now we're seeing signs that this is changing. Franklin Templeton's exploration of the altcoin market suggests that institutions are starting to look beyond these established players and recognize the potential of other digital assets. This is a major validation for the altcoin space. This isn't just a casual interest. Franklin Templeton is reportedly considering a significant push into the altcoin market. This isn't just dipping a toe in the water. This is potentially a full-on dive. This shift in strategy could open the floodgates for other institutional investors to follow suit. If a firm of Franklin Templeton's stature is willing to allocate capital to altcoins, it sends a powerful message to the rest of the financial world. Why are they doing this? A key factor is the search for higher returns. While Bitcoin and Ethereum have seen substantial growth, many altcoins offer the potential for even greater gains. Institutions are always looking for ways to maximize returns for their clients, and the altcoin market, with its inherent volatility and potential for explosive growth, presents an attractive opportunity. This is all about risk and reward. Franklin Templeton's potential entry into the altcoin market is a sign of a maturing industry. It shows that cryptocurrencies are no longer just a fringe asset class. They're becoming increasingly integrated into the mainstream financial system. This increased institutional participation will bring more liquidity, stability, and legitimacy to the altcoin market, paving the way for further growth and adoption. It's a game changer. Contrary to popular belief, Wall Street isn't afraid of risk. In fact, they thrive on it. The financial world is built on the principle of risk and reward, and the altcoin market, with its inherent volatility, offers a particularly exciting playground for those who understand how to navigate it. At its core, Wall Street operates on the principle that higher risk can lead to higher returns. Investors are willing to take on more risk if they believe the potential payoff is significant enough. This is the fundamental principle that drives much of the activity in financial markets. It's not about avoiding risk altogether. It's about managing it effectively and identifying opportunities where the potential rewards outweigh the potential downsides. For Wall Street, volatility isn't something to be feared. It's something to be exploited. Price swings create opportunities for traders and investors to buy low and sell high. The greater the volatility, the greater the potential for profit. This is why the altcoin market, with its often dramatic price fluctuations, is so appealing to many Wall Street players. They see these swings as chances to generate significant returns. Altcoins, in particular, offer a unique combination of risk and reward. While they carry a higher degree of risk than more established assets like Bitcoin or traditional stocks, they also have the potential for explosive growth. This high-risk, high-reward profile is exactly what attracts many Wall Street investors. They're looking for opportunities to generate outsized returns, and altcoins offer that potential. It's important to understand that Wall Street's approach to risk isn't reckless gambling. It's a calculated gamble. They use sophisticated tools and analysis to assess risk and identify opportunities. They're not just throwing money at random altcoins, they're making informed decisions based on research, data, and market trends. They understand that not every bet will pay off, but they're confident that their overall strategy will generate positive returns over time. This strategic approach to risk is what separates them from more emotional retail investors. For years, the crypto world has been talking about institutional adoption. Now, it's not just a prediction, it's happening. And it's not just about Bitcoin. Wall Street is actively pursuing altcoins, bringing a wave of capital and legitimacy to the market. In the past, Wall Street's relationship with crypto was largely one of observation. They were watching from the sidelines, assessing the market's potential. But now, they're moving beyond passive observation and actively engaging with the space. This isn't about waiting for altcoins to become mainstream, it's about actively driving that process. A key driver of this shift is the development of new investment vehicles, such as ETFs, exchange-traded funds, and other regulated products. These vehicles provide a more accessible and regulated way for institutional investors to gain exposure to altcoins. This is crucial because many institutions have strict regulatory requirements that prevent them from directly holding cryptocurrencies. These new products are bridging that gap. It's important to emphasize that this isn't just about altcoins reaching Wall Street. It's about Wall Street actively coming to altcoins. They're not just waiting for the market to mature, they're actively shaping it. This proactive approach signals a significant shift in sentiment and a recognition of the altcoin market's growing importance. This increased involvement from Wall Street has profound implications for the future of the altcoin market. It brings much-needed capital, liquidity, and legitimacy to the space. This influx of institutional money can fuel further innovation and development within the altcoin ecosystem. It also signals a broader acceptance of cryptocurrencies as a legitimate asset class, paving the way for wider adoption and growth. The convergence of Wall Street and the altcoin market is a major catalyst for the future of finance.
You take, the more return you should get paid for having taken that risk. And so in crypto, there is immense risk. But the further you get on the coin market cap list, the more risk you're taking. And therefore, you're going to need to drive a higher and higher return to compensate you for that risk. And that's exactly what Wall Street's looking for. Wall Street loves things that go up 10%. They love things even more that go up 100%. But if you show up and say, there's an asset that may go up 10,000% or it may go to zero, you have a line out the door of Wall Street investors who say, let me understand what this is. Let me try to value it. Let me try to predict the future. And I'm willing to risk a little bit of dollars in order to make a big return.
The crypto world is buzzing with anticipation about the potential launch of exchange-traded funds, ETFs, for HBAR and XRP. These financial products have the power to revolutionize how investors access these digital assets, potentially ushering in a new era of mainstream adoption. For those unfamiliar, an ETF is like a basket of assets that trades on a traditional stock exchange. Instead of directly buying HBAR or XRP, investors can buy shares of an ETF that holds these cryptocurrencies. This simplifies the investment process significantly, especially for institutional investors and those new to crypto. It eliminates the need for managing private keys, using crypto exchanges, and dealing with the complexities of digital wallets. ETFs are particularly important for attracting institutional investment. Many large institutions have strict regulatory requirements that prevent them from directly holding cryptocurrencies. ETFs provide a regulated and familiar investment vehicle that allows them to gain exposure to the crypto market without violating these restrictions. The availability of HBAR and XRP ETFs could therefore open the floodgates for a massive influx of institutional capital. Beyond institutional investment, ETFs also make HBAR and XRP more accessible to retail investors. They can easily buy and sell ETF shares through their existing brokerage accounts, just like they would with stocks. This increased accessibility can significantly boost trading volume and liquidity, making the market more efficient and potentially reducing price volatility. The launch of HBAR and XRP ETFs could be a major catalyst for mainstream adoption. By simplifying the investment process and attracting both institutional and retail investors, ETFs can bring these digital assets to a much wider audience. This increased visibility and accessibility can lead to greater awareness, understanding, and ultimately adoption of HBAR and XRP as legitimate investment assets. It's a game changer that could significantly reshape the crypto landscape. It's important to note that while this focuses on ETFs, the video also mentions existing ETPs, exchange-traded products, which serve a similar function, especially in markets outside the US, where ETFs may face regulatory hurdles. The cryptocurrency market is known for its incredible potential for gains, but it's equally known for its volatility. This inherent volatility means that risk and return are inextricably linked. Understanding this relationship is crucial for anyone looking to invest in crypto, especially in the exciting but often unpredictable world of altcoins. In the world of investing, there's a fundamental trade-off. Higher potential returns typically come with higher risk. This is especially true in the crypto market. If you're looking for the possibility of significant gains, you'll likely have to accept a higher degree of risk. Conversely, if you prioritize capital preservation and minimizing risk, you'll generally have to accept lower potential returns. It's a balancing act. Altcoins, by their nature, tend to be higher risk than more established cryptocurrencies like Bitcoin. They're often newer, smaller projects with less established track records. This means they can be more volatile and susceptible to market fluctuations. However, this higher risk also comes with the potential for much greater returns. If an altcoin project takes off, early investors can see substantial gains. This high-risk, high-reward profile is what makes altcoins so attractive to some investors. So how do you manage this risk? Diversification is key. Don't put all your eggs in one basket. Spreading your investments across multiple altcoins can help mitigate losses if one project performs poorly. Research is also crucial. Thoroughly investigate any altcoin project before investing. Understand its technology, its team, its use case, and its market potential. This due diligence can help you make more informed investment decisions. Finally, it's important to have a long-term perspective. The crypto market can be extremely volatile in the short term. Focusing on long-term growth and avoiding emotional reactions to short-term price swings is crucial. Remember, the potential for high returns in the altcoin market often comes with the need to weather periods of volatility. By understanding the risk-return trade-off and adopting a strategic approach, investors can better navigate the exciting but challenging world of altcoin investing.
Regardless of if someone likes them or not. Check it out.
What Trump is doing through this entity that he owns, he, and it's really his son, but because I don't think Donald really understands this stuff, is buying a bunch of crypto, Bitcoin and Hedera and XRP.
A bunch of things that might be approved for ETFs next year.
In the fast-paced world of crypto, rumors can spread like wildfire, often fueling speculation and market excitement. Lately, there have been whispers circulating about a well-known figure potentially acquiring significant amounts of HBAR and XRP. However, it's crucial to remember that these reports are currently unconfirmed. These rumors often originate from social media, online forums, and sometimes even off-the-record comments from industry insiders. While the exact source can be difficult to pinpoint, the information quickly spreads through the crypto community. In this case, the rumors suggest a connection to a prominent figure, which naturally amplifies the speculation. It's important to be aware of how these rumors start and how easily they can be amplified in the digital age. It's absolutely critical to emphasize that these reports are at this time unconfirmed. There's no official statement, no concrete evidence, and no reliable source to definitively verify these claims. Treating these rumors with a healthy dose of skepticism is essential. Don't base any investment decisions solely on unverified information. Due diligence and reliance on verified sources are paramount. Even though these reports are unconfirmed, they can still have an impact on market sentiment. The mere suggestion of a high-profile individual investing in HBAR and XRP can generate excitement and potentially drive up prices. This highlights the power of rumors in the crypto market and the importance of separating fact from fiction. It's crucial to avoid getting caught up in hype and making impulsive decisions based on speculation. Until there's official confirmation from a reliable source, these reports should be treated as nothing more than rumors. It's important to be responsible consumers of information and avoid spreading unverified claims. Always seek out credible sources and conduct your own research before making any investment decisions. Remember, in the crypto space, as in any investment market, it's crucial to distinguish between substantiated facts and unsubstantiated rumors. The crypto market is constantly evolving, making it difficult to predict the future with certainty. However, based on current trends and developments, we can paint a picture of what the market might look like in 2025. One key theme emerges: the growing influence of Wall Street. One of the most significant trends we expect to see continue is the increasing institutionalization of crypto. Wall Street firms, hedge funds, and other large financial institutions are becoming more and more involved in the space. This trend is expected to accelerate in the coming years, with greater regulatory clarity and the development of more sophisticated investment products. By 2025, we anticipate seeing a much more mature and institutionalized crypto market. This growing involvement of Wall Street raises the question: will the crypto market become Wall Street-driven? While the decentralized ethos of crypto remains important, it's undeniable that the influx of institutional capital will have a significant impact. We may see more traditional financial practices and strategies adopted in the crypto space. This doesn't necessarily mean a complete takeover, but it does suggest a significant shift in market dynamics. Alongside institutionalization, we also anticipate further progress towards mass adoption. As crypto becomes more accessible and user-friendly, and as regulatory frameworks become clearer, more individuals and businesses are likely to adopt digital assets. By 2025, we might see crypto becoming more integrated into everyday financial transactions, with wider acceptance by merchants and greater use cases in various industries. Overall, the crypto market in 2025 is expected to be a much more mature and evolved landscape compared to today. We anticipate greater regulatory clarity, increased institutional participation, wider adoption, and further innovation in blockchain technology. While volatility will likely remain a factor, the market is expected to become more stable and predictable. The convergence of traditional finance and the decentralized world of crypto is likely to shape the future of finance in profound ways. Don't hesitate. Hit that red subscribe button right below. Turn on notifications so you don't miss any of our new videos. On the MMO Crypto channel, we constantly share in-depth knowledge, sharp market analysis, and proven online money-making tips. Thank you for watching the video. See you in the next videos on the MMO Crypto channel.